So good afternoon, everybody. I'm Dan Binkin with the University of Northern Iowa's Advanced Iowa program. I want to thank you for taking your noon hour and spending it with us to talk about succession planning. Along with me today is one of my colleagues, Scott Bailey, who works as a consultant for us with the Advanced Iowa program. And he's going to be walking us through our roadmap process for helping business owners transition their firms, exit their companies in a way that they want to. So what we're all about here today is talking about a proactive approach to exit planning, rather than what often happens, which is more of a reactive approach based upon circumstances in life. And what we found is when we work with owners, we want to be proactive. We want to be doing things ahead of time, so that we can leave on our terms the way we want, etc. And so that's kind of the focus of what our presentation is going to be about today. A couple of quick housekeeping items. If you have questions as we go along today, please type those in the question Q&A box, which you should be able to find in the upper left-hand corner of your screen. If you have technology-related questions, if you can't understand something or having trouble using the Zoom technology, please put those in there as well, and our IT guy Patrick can help us out. Also, we've got a chat box that you'll see by the Q&A box, and in there we've included a link to some supporting documents that Scott may be referencing as we go along today. So I want to make sure that you know where to find that. That's in the chat functionality of the screen. So with that, real quick, just a minute here. Our Advanced Iowa program at UNI is somewhat new. Our focus is on working with small and medium enterprises through a variety of different programming, but primarily we focus on three big things. We focus on succession planning, obviously, which you're going to be seeing today, a little bit of the taste of that. We also do a lot of strategic planning work. We find that a lot of our companies spend too much of their time focused on the day-to-day activities of the business, and they never get time to kind of come up for air and look at things from a 30,000-foot view. And so we come in and help them do that through a facilitated strategic planning process. And then the other thing that we do is we get CEOs together on a monthly basis in the form of a peer roundtable meeting, where they can come in a confidential manner and talk through issues, process issues, share experiences together. And so just wanted to briefly touch on that. And now I'd like to introduce Scott. He's been on our team for the last 3 years maybe now. He has a lot of experience in succession planning and exit planning. He's been in this space for maybe 15, 20 years now. He's worked with over 40 companies on successfully successioning their businesses, be it to family members, key employees, and third-party groups. And so we're going to have a great chance here to kind of learn from an expert on some of the issues, and here's some of his thoughts on the process of exit planning. So Scott, if you wouldn't mind, you want to get started?
Ready to go. Thank you, Dan. I appreciate all of you who have taken time to attend, and I'm sure you have a specific reason for doing so. To get started, I would like to do this by way of intros, your introduction to me. Would you use the text box and tell me in a sentence or two or three who you are? In the most broad sense, who are you? I especially would like any of you in the audience who are owners to do this. And we may or may not refer back to this. I won't have an occasion to read this during the presentation, but if you would just go ahead and do that, I'd appreciate it. I understand that some of you are running and owning manufacturers. Others are contractors. At least one, I think, is in IT services. There are other service companies there. I've had experience with various clients in each of those spaces. Prior to doing consulting and helping through UNI, I spent a 20-year career with Pella Corporation, first in distribution, also in managing manufacturing division, and as well as doing ownership changes for these distributors across the US and Canada. That got me started in the whole business of leadership succession and exit planning and ownership transitions. And that's our topic today. So keep in mind questions that you have. Some have been fielded already, and we will address those towards the end. Dan will be our screener for those questions, and feel free to type a question at any point and send it in to Dan, and we'll get to that. Dan, feel free to interrupt me at any point if you think the question pertains to the slide that we're on, or wait to the end. Either is fine by me. So let's go ahead and get started. First, my learning objectives for you. This is my goal for this particular presentation, and I hope to contain it within 40 minutes to allow for a good amount of time for Q&A at the end. So 3 primary things. First, 3 questions with regard to exit planning that I would like you to have in your arsenal to ask yourself and answer yourself after this presentation. 3 quick kills that you can get started immediately this week, this month, that move you in the direction of good exit planning. And then 3 longer-term strategies to help you finish well that will take some time for you to implement, but which I'd like to tee up as a possible expectation for you to pursue. So let's get started with the first 3. So 3 questions, and we'll have different slides on each of these. The first question is, what exit price? What price do you need? The second will be, what exit path do you prefer to take? And the third is, what after exit? That is, what will you be doing after you exit the business? So first off, I like this particular slide because it gives us the image of 3 passageways, 3 doors that an owner must pass through to exit their business. First is the financial ability to withdraw. This means that you can do without the income as an employee, you can do without the income as an owner, and you can sustain the standard of living that you want for yourself and your extended family after you have sold and exited from the business. So there must be a financial ability to withdraw. Then there needs to be leadership successor readiness, someone that you feel confident in, either as an external buyer or some internal candidate who is going to do be in the best interest of the people that you care about, your customers, your employees and their families, your alliances with other businesses, with the community. So successor readiness is something that we'll be touching on as well. And then the third, and maybe the hardest for business owners, is to have a plan on what to do next that motivates and energizes you after leaving your business. So the emotional capacity to be able to withdraw from the business. The first 2 passages could be cleared, but the third could stop a transition if the owner is not ready emotionally to withdraw and let go and move on to something better, a higher calling. So let's talk about the price first, exit price. So what money do you need in order to leave the business? What is your business worth right now? And so then we can analyze the gap of the need to the worth of the business and decide what to do with that. So I like to recommend that that you visit with your financial advisor to calculate based on the standard of living you want to maintain. And many of you likely have already done this. If you haven't, it's something that's important for you to do. And I'll give you an example of what this might look like. In terms of valuing the business, we'll talk about the various ways that you can come up with a value of the business, and then what to do about any gap that means basically financially you're not ready to walk through that first passage of financial readiness to leave the business because there's not enough value yet, and we have some work to do to grow the value of the business. Here are some ways of valuing your business that are pretty standard, generally accepted valuation approaches. The first would be asset-based. This would basically be book value, the assets that you're going to sell minus the liabilities that you would ask somebody to assume. But the assets then would be marked up to some market value, especially if you have land or buildings. That would be not book value, that would be market value. But basically it's selling off assets. The second approach would be a market-based, some multiple of sales, and often you might hear of similar businesses within your industry that get sold at some multiple of sales. That would be a market-based valuation. The third, and maybe the most often used in my experience, is the income-based approach, some multiple of cash flow. Now, you may be familiar with this acronym EBITDA. But if you're not, it stands for earnings before interest, taxes, depreciation, and amortization. So basically, it's the bottom line of your income statement, adding back depreciation and any interest expense, and certainly adding back any tax if you're taxed at the corporate level versus just on your personal tax return. So those are the generally accepted approaches. Now that gives you the top dollar value, but then there are reasons to discount that price. And some of the appropriate ways of discounting have to do with it being a small business. There's a small business discount rate that an astute buyer or a broker that's coaching them will know about and want to discount your value. There's also a minority owner interest if there's a lack of control. That is, if you're buying something for less than, say, 51% ownership control, then you're a minority owner and lacking the control. There's another discount rate that could be applied. Then if your business is also not that marketable, certainly a publicly traded company is much more marketable than a private one who's not on any stock exchange. And it gets even more so to the degree that you're in a rural setting and there are not that many businesses like you around to even compare against. There could be a lack of marketability discount on the business. And then there are capitalization rates. One more sophisticated approach to buying a business is instead of just a multiple of the number of years of cash flow that you would pay, you might actually look at the future cash flow of the business, including balance sheet changes and growth in the company, and then discount it based on some value of the dollar in terms of a capitalization rate and find out what the present value is. There are many people that can help you with that. Certainly someone who is certified as a business appraiser is trained in doing these things. Then there's someone in your professional network like a CPA might be able to give you a ballpark number, but not necessarily go through the valuation process. And then there's your own expectation of what it's worth. And that's really what it comes down to. What a willing buyer and a willing seller agree to is the price. Let's move on though. I would like to plant this seed of thought. When you go to sell your business at a certain price that you have in mind, the purchase price does not equal the net proceeds. You must know this. I know that you know this, but I'm going to ask you to think through it a little bit more deeply. And so this slide is to trigger that thought process, because let's say that you have some loyal employees that you think have leadership capability, but not the net worth means to be an owner. So you've ruled them out in your mind. Well, in that scenario, you probably have in mind what you think your gross purchase price is, without thinking about how little of that will remain as a net proceed to you after you've paid your federal income tax that could be up to 40% on whatever's above your cost basis in the business, the state and county income tax that could be double digit as well, any liabilities that the buyer will not assume that you have to pay off with the proceeds. If you employ someone to help you in doing legal documents or business coaching or a broker, there are professional fees to be paid. And then if you're a C corporation, which some of you might be, then there's another level of taxation, which is, of course, on the capital gains paid inside the company on any dividends. Excuse me. Let me back up. If it's a C corp, the things that I stated above are all taxes or fees that are incurred at the C corp level. So then we get to a net proceeds that can be distributed to the owner. At that level, then you have to pay as the owner, the shareholder, additional capital gains tax on whatever is dividend to you or liquidated. And then for those of you that are in the higher income bracket, there's this 3.8% that you'll have to pay as well in addition. So the net proceeds on $5 million could be very little at the end of this long list of things. So the goal then, the takeaway that I want you to have from this slide is that you should be focused on maximizing your net proceeds. And when you think about net proceeds versus purchase price, now you're going to think about buyer candidates differently. Now you're going to think about the worth of your business differently. And you're going to think about the timing of your exit differently, because You might have thought it without thinking too deeply that you had access to the full purchase price, and indeed you do not, to live off of. So we spent maybe a little bit more time than we should have on exit price given our short lunch hour. I hope that you'll find some interest in that. Let's go next to the question of exit path. So what does leaving or exiting your business mean? Now, there are two phrases that come up often. One is called succession planning. It focuses on developing a leadership bench strength to achieve a smooth transition in the management of the company. Now, I'm imagining that many, if not all, of you owners in the audience are actually actively managing your business. And so you have to replace yourself as the president and CEO in a management capacity. So that even if you hold on to the company and you never sell it, that you need some succession planning for bench strength for leadership. But then there's this phrase, exit planning. Now, exit planning includes succession planning because certainly you can't step out of management unless you have leadership ready to go. But it includes an additional piece that succession planning may or may not include, which is cashing out of ownership. So this is a broader term that I personally like to use. Let's go on then to the type of exit paths. And Dan alluded to this at the beginning. You can pursue at a maximum sale price an outside buyer, maybe a strategic buyer at that. You could consider passing it to a family member or members, key employees, or some other, including ESOP, which is growing in popularity due to its tax efficiencies. So if we had time to go into breakout groups, I would break you up into these 4 categories and give you handouts, which will be available to you at the end of this presentation that help talk you through key questions. I think one was already asked about what are the pros and cons of selling to family. So that would be number 2 on my slide. And there's a handout that will talk you through key questions to ask yourself to see whether or not this exit path is best for you. And these handouts will help you with each of these other areas as well. So I'm going to keep moving on. It's something you can read about later. Selecting the successor. Okay, this one I think is pretty key. I want to sit on the slide for a few minutes. First is the owner's exit readiness. Now, we talked about those 3 passageways: financially ready, leadership succession ready, and emotionally ready to exit the business. So the owner has to be ready, or it's just not going to happen. You're not going to hand it off. Then the next question, moving around on my slide from left to right over the arch of these boxes, says who. That is, who has to have buy-in and has influence over who you pick as a successor fit? Is it solely your choice because you're 100% owner and founder of the company and no one would ever question your right to select the successor? Or in other situations, maybe a spouse or children or a business partner or a board, maybe somebody else has influence, if not a direct vote and say in who the successor should be. Buy-in of your management team. So says who is important to think through. The next area to think through is where is the business in its life cycle? You know, a business that is a 2nd or 3rd generation ownership already, who's actively managing the business, is going to be much different from one that was started with the existing principal who's already leading the business. So kind of the family ownership cycle, slightly different than the business cycle, is important to consider. But then there's also the maturity of the business itself and what's next for it, which leads me to the next box on strategic planning. Now, some could wait for the successor to determine the next strategic plan on where the business needs to go. Larger corporations like to do the succession plan first, get board buy-ins, shareholder buy-in, and then find a successor that actually has the skill set needed to execute the strategic plan. So think through which you would pick first, successor, then strategic plan, or the opposite. Next would be the candidate's assessment. Understanding, is the candidate or candidates that I have in mind, are they qualified? And if not yet, but maybe in the future, what additional development steps are needed for them to be ready? And then that's the last one, candidate readiness. in order for the owner to actually hand something off, to hand off the business leadership component, there are really three things that have to be handed off. First is the responsibility. That would be a statement something like, as the owner, I'm still the CEO, but I'd like you as the incumbent CEO to do the work for me. Then there's the handing off of authority. I'm going to make you the CEO. You do the job, but remember, I'm really in control and I can change my mind or influence you at any time. The third level of transition or transfer would be that of ownership, where you set a firm date for a full transfer of ownership to be complete. Now, it can be very frustrating for the successor if they get stuck at just level 1 or even level 2, but they were promised or have aspirations for level 3, meaning ownership transfer. So keep in mind that that should be your goal if you want a smooth exit for your successor in the business as well as for yourself. All right, so we've covered the first third of this presentation has been about the 3 top questions that I'd like you to ask yourself afterwards. What exit price, what exit path is preferred, and what am I going to do after exit? Okay, that's, I guess we'll touch on this a little bit more here. But I want you to know yourself, and in a way that is not connected only or solely to the business. If you recall at the beginning of this presentation, I asked you to text me an introduction of yourself. And so if you did, what did you write? Did you tell me what business you own and run? Or did you describe yourself in a broader way that reveals a greater life mission outside of your business? It's important for you to be able to envision the journey that you're on with this company coming to an end, and what's after that end that is even greater and more glorious to you, that fulfills a deeper purpose. Maybe you're a perpetual entrepreneur and it's starting another business. There's got to be something that's attractive to you for you to want to exit the business and to have that in mind to draw you through these passageways that we've talked about to be ready to exit the business and leave it in good hands with a successor. So I think we've already reviewed what exit price, what exit path, and what after exit. Now for the 3 quick kills. First, to identify the financial gap, I alluded to that earlier, SMART goals, which I'll talk about, and plan C, because things don't always turn out as you expected. So I talked about, if you haven't already done so, with your retirement planning person, your financial advisor, hopefully they're a CFP, certified financial planner, talk to them about what kind of standard of living you want to maintain after you retire from being an employee, basically. So let's pick in this example, $100,000 of annual income. And this would need to be after-tax income that you're actually spending. So $100,000 that you spend every year beyond just taxes. If we look out, and let's just say that you're age 50 and that you're going to retire in 15 years at age 65, let's assume a 2% growth rate. And then on the monies that you set aside in your retirement funds, let's assume a real growth rate of 4%. Net of inflation. So it would have to be 6% less the 2% inflation to hit the 4% net real growth. Okay, assuming that, you would need $2.5 million in the bank that is in your retirement funds when you retire at age 65 in 15 years. So if we look at, if we were to assume that, gosh, you only have $500,000, I need to get to $2.5 million. I got 15 years to do it. Where's that going to come from? So let's assume that you've already done a reasonably good job of setting aside retirement funds, and you have $500,000 in some kind of an IRA, and that will grow over the next 15 years to a projected $900,000. So that would be a good scenario. So we'll take the $900,000 away from the $2.5 million, and we have a remaining need of $1.6 million. Now you own the business, so that's going to help you cover that gap that you have financially to be able to exit the business financially. But what if it's not worth $1.6 million right now? What if it's only worth $1 million right now? Now I got a $600,000 financial gap that I have to close somehow, and one way to do that is to engage further with the services of Advance Iowa to look at their value driver program, to take a close look at how can I drive the value of this business, because I need it to be 600,000 higher than it currently is. That is the financial gap analysis I would like you to do, that I believe is a quick kill, that if you put your mind to it, this can be known within weeks. Here's the second quick kill. Hopefully, some of you are already employing the strategy of setting goals, and setting goals that are SMART. So this is a well-known and used goal-setting acronym. The SMART standing for S for specific, so you're defining exactly what the expectations are, avoiding generalities in your language. And this is a written sentence or two, or bullets underneath it. So that's a written goal, and it's specific. It's measurable. That is, you could measure it at the end to know if you achieved what you're looking for. It's achievable, so you don't set a goal that you need to get from a 1 million value business to a 10 million value business in 5 years. Maybe that's beyond reason. So make sure it's achievable. And then it should be relevant to what you're going after, obviously. And lastly, time bound. Set an end date and maybe even some checkpoint milestones. So when you're looking at how to close that financial gap in Quick Kill 1 that you get identified, apply SMART goals to get there. The third quick kill is to have a plan C. So things go wrong. You won't live forever. You know that. You might not want to focus on planning for a successor in leadership or for exiting ownership, but you can maintain a greater peace of mind. You can retain control over the who, when, and how of an ownership transition if you think ahead and keep your options open. This is having a plan C. So we do have some helps that we can give you to think through what needs to be, what kind of documentation do I need to have in a plan C. And it could be things as simple as, here's where I keep the master set of keys and passwords, and here's who I want to make this decision that I'm the only one that makes, and I want so-and-so to make that decision that I'm the only one that makes. So writing down those very basic things for the first week to 90 days of your unplanned absence is what I have in mind here. And there's a longer term version of this that we'll get to that would be much more elaborate in the business continuity planning side. Those are the three quick kills. So a quick review. Being 2/3 through this presentation, identify your financial gap, write SMART goals, and have a backup plan that people know where to go get that information of what to do in an unplanned absence. Okay. Lastly, we're going to look at 3 long-term strategies that I would like you to get in your mind, and hopefully that you would actually aspire to pursue these. Some of these concepts that I'm going to mention come through this wonderful book, Finish Big. I had a client in Iowa who recommended this to me, and they knew that I was working in the whole space of exit planning, and I'm really appreciative. I also got a chance 2 summers ago to talk to Bo, the author of this book. I saw him present, and that was a fantastic opportunity to shake his hand and speak about some of the things that are in his book. One of his quotes, build it to last forever, build it to sell tomorrow. So keeping in mind that although you want to stay there for forever and really may have no plans to leave the business, it's a benefit to you financially, a benefit to the business, to all who are around you to be ready to sell it tomorrow. Then John Brown, who is the author of the Exit Planning, the Definitive Guide. I'll have this listed in the resource at the back at the end of this presentation. Anyway, we're quoting him as having said, change your role from hands-on and heads down to hands-off and heads up. And I'm sure I don't have to explain that to you. Each of you are probably very active in the doing of specific roles in your business versus stepping aside and thinking about how to work on the business from an exterior or outside perspective. That's what we have in mind here. In the book, Finish Big, there's a chapter that talks about the sellability. And Bo in Finish Big does a great job in this particular chapter, forcing us to think like a buyer. And possibly some of you actually didn't start the business yourself, but maybe bought it from somebody. So go back to that mindset when you saw the business and you were looking at it. What did you value looking at the business? What frightened you from thinking of taking over this business? Think like a buyer. So here are some of the sellability factors that are mentioned in this chapter in the book. First, what's the financial performance? Is it cash flowing? What's the potential for growth? Is there an over-dependence upon one customer or one supplier that puts this business at risk, especially if the owner or operator leaves? Cash flow again, the P&L could maybe look good or bad, but the cash flow looks better or differently than the income statement says. So looking at the actual cash flow of the business. And then reoccurring revenue. What percent of the revenue has to go out and be won and hunted down every year versus it being a recurring client that's loyal, that plans to stay for many years to come? Recurring revenue. And then the unique value proposition. Is this a commodity business? Do they have a unique space that is of value to the end customer? These are good questions for you to consider from the buyer's perspective. How would you change your business if you were the buyer again and needed to buy it? And customer satisfaction, the strength of the management team. A lot of buyers might be a strategic buyer and they want access to your channel or your service or your customer base, but they don't necessarily want your management team. That's possible. But there's going to be a lot of people who maybe they're more of an investor than an owner-operator, and they don't want to take on a business that isn't going to run by itself. They need a really strong management team. So think in terms of how your buyer would think. The second long-term strategy here is the continuity planning. I alluded to this earlier on the quick kill. So there's more to be done in business continuity planning. And even, let's just say that you have in mind a successor that's inside the business or inside the family circle, extended family circle, and you start planning and you get that person in place. And then you find out that they're not performing the way anybody expected, and you need to jump back into the business and salvage things and turn it back around. And now you need a plan C. Your plan A didn't work. Maybe even a plan B didn't work. So having some business continuity planning in advance, there are advisors that can help you with this that are trained in exit planning, including people at Advance Iowa who can help you with this. And certainly there are the 4 Ds that surprise and cause maybe most ownership transitions: a disability, divorce, too much debt, and death. So the last strategy that I want to tee up to you is that from Bo's book, Finish Big. Your exit isn't over until you're fully engaged in whatever comes next. Think about that. Because when you think about, gosh, what's the value of my business? Who's ready to take over leadership? Who could take over ownership and eventually pay me off? You're not done when you get through those passage doors. You really won't be done until you find your place in life, your purpose, to pursue something else that engages your mind, challenges you, that excites you, that leaves a legacy. So your exit isn't over until you're fully engaged in whatever comes next after your exit from this business. Everybody needs to be going somewhere. Some are serial entrepreneurs, and this business that you have might just be a stepping stone to the next venture that might be even bigger, greater, or of more long-term value to those that you care about. So use your wealth as a stepping stone. That is, use the wealth that you create through driving the value of this business and eventually exiting it. Use that wealth, that new wealth, as a stepping stone to an even higher calling. So let's go ahead and review. We first talked about 3 questions that you can be asking yourself. What exit price? And think about net proceeds, not just gross price. Some people, I've seen get stuck on man, I just need to get a 6 times EBITDA, a 6 multiple, and I'm out of here. This is going to work for me. Well, a 6 multiple of your cash flow each year, that is 6 years worth of future cash flow, that's not the net proceeds. So it's important to calculate what's left after you pay off all your tax and other obligations. So what exit price? What exit path? Is it going to be the family, an insider, some outside buyer, an ESOP, or some other choice? What after exit? What's your next step, the next higher calling for you? Again, the 3 quick kills that we talked about. Talk to your financial advisor, identify what the financial gap is for you to retire and achieve the standard of living that you want. And then write SMART goals, specific, measurable, achievable, relevant, time-bound goals to overcome that financial gap. And help train those in your company to also write SMART goals on anything that they do. Then third is to have your plan C. If you get hit by a bus, someone should know where to go to get the file or the paper or the electronic document that's going to say who should do what over the next 90 days and how do I get into that information, keys, access codes, etc. And we talked about 3 long-term strategies to finish well. Thinking about your business as a buyer would, business continuity, and the whole finish big concept. And by the way, it's an exciting read. I just was riveted when I read Finish Big, and I would highly recommend it to you. So I think now, Dan, we're ready to go into Q&A, and then if there's any time afterwards, I can go through a few appendices to show other resources that are available to our audience.
Perfect. Hey, Scott. We do have one question from the audience maybe that we could address first, and then
Yes.
I know that folks have some specific questions. If we can tackle a few of those as we go, but if you wouldn't mind putting a few of them into the Q&A box, we'll also be able to see them there and address them now with the time that we have remaining. So,
okay.
First one here is from Neil asking about good multiple for using EBITDA as a valuation tool. You want to start on that one, Scott?
Well, it's unique to the industry that you're in. So Neil, I wouldn't be able to. I could give you a range for distribution and sales. I think it covers a lot of different industries, and I would say in the 3 to 6 multiple is the range. You'll very often hear about a 5 multiple would be very good, but it also depends on the economy. As you know, there are better times to sell a business and worse times. And so when you're on the downside of that, you might only get a 3 or 4 multiple. You're on the upside of that, it could be significantly higher than 5, but that would have to do with your future growth potential. So for instance, one of the things several things that would be really valuable to a future buyer is that you have invested in talent of people that have still growth capacity in their career, that are on top of their game already and have a plan to drive this business significantly larger. In that situation, the expected future cash flow growth from the business will give you a much higher multiple of historic trailing, 1, 2, 3 year EBITDAs.
Yeah, and one thing that I would add too, Scott, is that so we have for rough, I emphasize rough rule of thumb type of measurement. We have some different resources here at UNI, and if you'd be willing to after the fact, or if you're interested after the fact, we'd be more than happy to kind of do some rudimentary rule of thumb valuation work with you to get you some ballparking for your industry. We have several different sources we can draw upon to kind of get you a few data points to help kind of get you hopefully pointed in the right direction to confirm your thoughts, or maybe give you pause to think about things that you might want to be doing to kind of fill that gap. So I would just add that we, offer that to our clients. So if that's of interest to you, please get in touch with us, and we can talk through your industry specifically and some of the discounts that might be applied to it, and rule of thumb concepts for it. So
before you go on to the next question, Dan.
Yeah, go ahead.
So a multiple of what? We said that the unit of measure would be EBITDA, earnings before interest, taxes, depreciation, accumulation. But if you just look at the last year or 2-year average, it may be lower or higher than should be used to do this multiple against. So there are adjustments to EBITDA that are significantly impact the purchase price. And some of those adjustments might be if there's some one-time loss that isn't relevant to ongoing operations, you'd want to add that back. Or if it's a one-time gain, obviously subtracted. Sometimes for tax strategy purposes, there are more expenses that are loaded against the business than the next buyer and owner would necessarily incur. And so those can be added back to your EBITDA before you do your multiple. So there's where a lot of negotiation occurs even after you agree to a multiple.
Yeah, absolutely. Yeah, absolutely, Scott. Good point. So we got a couple of questions about a couple of the slides, Scott.
Okay.
One in regard to when you were talking before, personality standpoint, apathetic, engaged.
Oh yeah, I'll go back to that slide.
Perfect.
Oh, I'm going the wrong way. Sorry, guys. Let's try this again.
No problem. So that's referring to kind of that authority responsibility graph. One thing that I'll add into that too, Scott, is that we see a lot of our owners currently, we refer to him as Founder Frank, but Founder Frank has built a business where he's at the top of a very steep pyramid, and everything comes through him or her for approval, I guess, for lack of a better word. And I would say that what we're seeing with newer generations of buyers of firms is that's not the kind of company they want to buy. They want to buy a company that's a little flatter. They want to buy a company that has, folks have a little more autonomy, a little more responsibility, and that pyramidal hierarchy is shifting toward a flatter one. Just wanted to mention that quickly. When you think about getting yourself ready for sale, think about what a buyer in a younger generation is going to be looking for. Anyway, go ahead, Scott.
Well, could you restate the question? I know that was on this slide, but what was the question?
So Val's asking, is this referring to authority, the authority responsibility graph?
Yes.
Okay.
That is, well, I'm not sure I still understand the question. You mean is the graphic on the upper right referring to? It is. So let's just look at that graph for a minute. If the owner that is already running the business versus the successor, if the owner retains a high amount of authority and then delegates a lot of responsibility, we might, I can see the confusion on the graph now because I'm confused myself describing it. The fully engaged, let's talk about the upper right. Fully engaged would mean that the owner has passed off responsibility and authority. It's when both don't go that it causes some combination of frustration to the successor and a tyrannical situation, at least from appearances, maybe not in truth. Or it might just cause the successor to be apathetic because I really don't get both authority and responsibility, and I can't win in this situation. So the graphic is trying to land the point, pass on both responsibility and authority that are equivalent, and eventually ownership.
Thanks, Scott. I was just going to see if there's any other questions here that folks might have. I know we got a question about, is this going to be available as an archive? Absolutely. We'll have it up on our site at advanceiowa.com. And this was maybe a good time for me to also mention that we're going to be doing this again live in a month. And I'll grab the date so that we can give that to you. Val specifically, I think, is asking about that. And I also want to make mention that this is part of a series that we're going to do on succession planning. So today was kind of an introduction to some of the things to be thinking about. I know Scott, in a later date, one that we're going to do later this summer, we're going to talk through kind of, so we know what we think our business is worth, and then we find out what our business is maybe actually worth, and then is there a gap? If that answer is yes, how do we go about kind of filling that gap? What kinds of things? And you alluded to them earlier, Scott, with recurring revenue, diversified client base, things like that. We're going to try to get into that a little more specifically, because I think that's pertinent for a lot of owners. We see that, as with anything else, you always think what you have is worth more than maybe it really is on the open market. Folks don't take into account the things that you talked about earlier about liquidity, about discounting based on where you might be located or the industry that you're in. And so quickly, our 2 million number becomes 800,000, and that isn't quite what I had in mind, type of thing. So let me just give those dates real quick while I have them. So the next time we're going to get together is June 28th, and we're going to talk through this presentation again. So if there are people that you thought should have been here that weren't, please let them know that we're going to be doing this again June 28th at noon. And then in August, on the 24th, we're going to be talking more specifically to value drivers, how to increase the value of your firm, and hopefully doing that in a proactive way with a few years left on your time frame, and what kinds of things can you impact. And sometimes I equate that to the housing market. You're getting ready to put your house up for sale. What are the things that we can do? Flooring, curtains, tear down the wallpaper, get rid of the shag carpet, whatever it might be. Obviously, in a business, you're not able to do that in a couple of weeks, but if you've got a little time on your side, there are definitely things you can do to enhance the value of your company. So, Scott, I don't know, are there a couple of things you'd like to also include as we wrap up here in case we get
Yes. Yeah, definitely. And interrupt me if we get another question. But on that line of how to increase the value of your business and use time to your advantage, if you are a C corporation and aspire to retain a higher amount of the proceeds after sale and avoid the double taxation, you need a certain number of years head start to convert it to, say, an S corp. If you do it with too few years left before you sell, the IRS could reverse it and say, no, that was just trying to avoid taxes move, and that is to evade taxes move, and they would undo it. So there's a certain number of years ahead that you have to make changes like that. And also I would say, I guess one of the questions that we fielded prior to the start of our presentation was that of how do you motivate an organization to even want to do succession and exit planning? And I would use these terms because I think they're what will most resonate with you as owners in the audience. And that is, do you want the peace of mind of knowing that you have a plan A, B, and C on what's going to happen to the business if the unexpected happens? Do you want to stay in control of your situation so that you dictate the timing of your exit from management, your exit from ownership, to who and how? If you want to stay in control and you want the peace of mind, then plan ahead, because that's how you keep more options open to yourself and how to do this. By just keeping your head down and working in the business and not on it, something will eventually stop you from that path, and it will reduce your options, it will reduce the value, it will reduce your peace of mind, and it will take away control that you currently have that you could have applied towards planning.
Hey, Scott, maybe one question too, could we talk through quick? A lot of the firms that we see and work with are family transitional from one generation to the next. And I know you've had a lot of experience with that, working with us and over time in family transitions. Can you touch briefly on maybe a few of the things that you see common in terms of, maybe speed bumps or some of the pros and cons there that maybe folks aren't always thinking about? We hear the terms fair is not always equal and that kind of stuff. Could you touch on that a little bit?
Sure can.
Great.
One of the things that you should think about is you have family governance, then you have ownership governance, and then you have management governance. What do I mean by that? You have a management team that runs your company. They don't own it, and they may not be family. Then you have ownership governance, and maybe you're the sole owner, but there are other people that influence you, like your spouse or someone that has your ear more than another family member. And so there's ownership governance. And then there's family governance. Who's the one that holds the family together? Who plans the events? Who's the matriarch or patriarch of the extended family that has a lot of influence and say? So when you think about your responsibility in each three of those three, and I'm imagining that if you founded this company and you're still running it, you're in all three. You're in management, you own it, and you're the head of your family. So now you got to think through in family governance, and now we're back to the question, what are the pros and cons of passing off ownership to a specific child or cousin or uncle or spouse or whatever? One of the delineating questions that you should ask is, must they first be business active to even be considered for ownership? And often families will consider an age cutoff. They might want them to get their education done and maybe go get a couple, 3-5 years in another business, but they got to make their decision by age 30, for example, to be business active to even be considered for ownership transition. So the first question is, do you require business activity first to qualify? And does the rest of the family know that that's your requirement? And by what age? That will help start to set expectations within the family governance circle so that people know what to expect. Another important piece that you'll have to decide is within families members that you employ to become business active, do they get their spot by virtue of being a family member, or do they have to earn their way to a certain rank or compensation? And both are fine. It's your business. You can do it either way you want. But it's important to be consistent and let the extended family know, look, we earn our spot here. I would be happy to put you up against other candidates that I have for this job, but you need to earn your way. I'm not going to back every advance for you. You need to earn it. Or it's the, hey, we're family, we're loyal. That's just the way it is. The people that are not family, hopefully they'll embrace that. Otherwise, we'll find somebody else. So just know what environment, what culture you're going to build. So in terms of any more answer to that question, I would like to put you in the direction of some handouts. There are specific questions that will lead you through the pros and cons of transition to family ownership.
Thanks, Scott. How about one more question that we got in advance about buy-sell agreements?
Oh, yes.
I know part of our process, and maybe you could touch on it a little bit, is we're not going to write a buy-sell agreement, obviously, for our client, but I think we're obviously going to make them aware of things that they want to make sure they have in there. And maybe you want to touch on that just quickly?
Happy to. Here are the key components that you need to talk to your attorney, and they will tell you this as well as we will tell you this. But you need a formula for what the purchase price is going to be. So we've talked a little bit about that. Won't elaborate. So first, it has to have a formula for the buyout that's flexible enough for a future event when the conditions have changed in the company. The second thing that you need is the pecking order of who gets to buy first. So first right of refusal, second right of refusal, and so on. And within that first right of refusal, you need to make clear and decide which party. Is it the company that has the first right of refusal to buy out another party, shareholder, or is it the other shareholders that have the right to buy out an exiting shareholder? And in what order do they have access to do that in? So those are some of the basic components that you need to have. I guess the last one I want to mention is a buy-sell isn't worth anything if you can't fund it. So you need to have some kind of insurance mechanism or some other way, money in the bank, net worth that's already been built up, such that the person who has the first right of refusal or second and so on to buy out an exiting owner has a way of funding it. And so there are great products out there that we can point you in the right direction to consider.
Thanks, Scott. I appreciate it, and I appreciate everybody's participation today. Your time. We're basically up against noon, or 1 o'clock rather. So I think we will get ready to close. I again appreciate you all being here involved. If you have questions, we'll continue to stick around for a couple minutes. If you want those answered privately or otherwise, we can do that. Just type those in the Q&A or chat box to us. Quickly, I just wanted to remind you as well that we're going to do this again on June 28th at noon, and that'll be a similar structure to what today was. And then on August 24th, we'll have a little different topic in this series. We're going to be talking more about the value drivers of your firm, as I mentioned before. How do we get our business more attractively set up for sale and push the value of our firm up a little higher than maybe where it is right now. So that's on August 24th at noon. Thanks to everybody again for joining us. Have a great rest of the day. Thank you.